Hello traders, my name is Doc Severson and this is the TheoTrade Nightly Report for Thursday, June 2nd. Before I get to the charts tonight, there's a series of events coming up over the next 2 weeks that are going to be just like a series of dominoes that we're going to have to deal with. And for all intents and purposes, these events are what are moving the markets these days now. And it's not earnings, it's not PE, it's not performance, it's not anything like that. Right? So it's all about what's being priced in through central bank policy. So the first event tomorrow is the jobs report is coming tomorrow at 8:30 a.m. Eastern time. And right now it's looking for a consensus number of 158K. And that's a real layup based on last month's number of 160K, which was well below expectations. So 158 is a relatively low number to hurdle. What we are always wondering is whether or not if the numbers on the light side, is that going to be more positive? Because bad news is good news, because that means that Janet Yellen will not hike rates in June. Or if we get a really hot number above 158K, does that mean that she has to take action in June or not? Okay, after that, what we're going to find out is sort of the tone of what Janet Yellen is thinking, because on June 6th, which is this coming Monday, in Philadelphia, she's going to be giving a speech. And a lot of times these speeches will be very closely monitored for hints in terms of the upcoming Fed policy. And of course, after that, we have the June 15th FOMC, not only the policy plus the press conference. So both of those are coming in the afternoon. So by then it should be a done deal. It should be pretty well priced in terms of what the expectation is, whether or not she's going to raise rates on that date or telegraph the fact that rates will be raised in July. Either way, it doesn't matter. By that point, what actually happens should be priced into the market by that point. Now, this is well before the meeting, right? So this is on Thursday night, and right now what we're only showing is a 20.6% probability that she will raise rates in June in 2 weeks, right? But what it's also showing is that there's a possibility of about 50% of possibility that those rates will be raised by the July meeting. So there's even odds right now for the July meeting, but still relatively low odds for the June meeting. So this is what it all comes down to, regardless of whether it's rates or not, whether we're going to hike or not, but it all comes down to one thing, which is certainty. So this is what the market craves, is certainty. If the Fed adequately walks the tightrope between keeping inflation in check versus keeping growth in place, then the certainty will return to the market and we will more than likely rally from this point. So is that possible with the price jammed up against S&P 2100? Well, what I'd like to do now is go over to the S&P chart and then the sector indices to figure out what's going on and what's driving the market right now, as we've seen strength coming into Thursday night. Okay, so I'll use the spider charts here, which is the ETF of the S&P 500, because this is what most people are trading right now. And so what we're seeing is this massive consolidation pattern that we've been in for about the last year and a half or so, which is over 300 points in range. And so what I'm seeing here is, as we talked about the other day, is that markets can correct through time instead of price. And this is a poster child for that. So instead of the price coming back down here to the 1600 area on the S&Ps, which is what I felt that we would do, instead it's done quite the opposite of that. And I'll get to that effect in just a minute. So you can see this in a little bit more detail on the weekly chart, how the price is just jammed up against this resistance point here at around the 2100, or in this case on the spiders 210 to about 213.78. So right up in this area is where the action is, and I would say there's a very good chance that the price is going to be outside of this range in the next 2 weeks. So right now the price has been in this range here for several weeks, between about 203 up to about 211 on the spiders. We will exit that range, and more than likely it's not going to wait until the middle of June to do so. Price is always going to discount future events and price in based on what it thinks will happen. Now, in Tuesday's report, what I talked about was the fact that a lot of people right now are recognizing the same type of pattern here and saying, oh, we're consolidating up under 210, so we're going to get another move down to the downside here. So they're making that assumption based on that what happened before is going to happen again at the same time. Well, what's different this time, what is different this time is that there's much more participation in this rally. There's a lot more participation in this recent rally off of the February lows, right? So we have many, many more stocks. In fact, we have about 75% of stocks are currently above their 200-day moving average. Back in these times, back in August and back in December, that figure was about maybe 50%. So there was a undercurrent bear market in action during both of these. That was only a few stocks were actually pushing markets higher at the time. Now we have much more broad-based participation. So this is why I think it's different this time. And with that said, I think the pain is to the upside right now. The pain is to the upside. So what you have to ask yourself with any market move is, what direction would the price have to move to create the greatest amount of pain to the largest cross-section of traders out there? And I do believe it is going to be to the upside, because nobody's expecting the move to be going to the upside. People are saying, hey, this 210 to 213 level on this S&P 500, that's like the Maginot Line. That's impregnable. Well, price will never get through there. So more than likely, we're going to be coming back down to 1800 again. So the other sentiment readings right now is that nobody's really bullish out there. Everybody's very neutral. Nobody really has an opinion about where things are going. So in a way, for not voting, that's almost a negative skepticism. And that is a very contrarian figure as well, too. So what does this all mean? Well, it's not going to surprise me if we do break out to the upside. I'll say that. Again, you have to go into these types of events with no bias whatsoever. Don't be surprised by anything. Have a plan A if the price breaks higher. Have a plan B if the price breaks lower. Just box in the current range and say, all right, this is what I'm going to do if the price goes higher than here. Or this is what I'm going to do if the price goes lower from here. Either way, I think things will happen very, very rapidly. I don't think people are really prepared by the amount of movement that we're going to see over the next 2 weeks, just because of what's at stake right here. So what I'd like to do with this, now I made this comment before, is that we have more participation here. We have more of a broad-based rally than we did for either of these two events, right? So let's go through the S&P sector spiders and see where those charts are and see where the strength is in this current market. Okay, I'm going to just go through these one at a time really quickly. This is the XLY, which is consumer discretionary, and you can see the price is very, very close to all-time highs. Really no weakness here. Okay, here's XLV, which is the healthcare spider. And we're looking to see whether or not the price can break above this important $73 level, in which case it should very quickly ramp back up to all-time highs near 77. So once again, this is a bullish consolidation pattern. The next chart is XLE, which very honestly has been the biggest drag on the S&P over the last 2 years because of the fact of oil dropping like this. Okay, strong rally off of the bottom, but to me this is only going to create the next lower high before it rolls over at some point. So even though it's been relatively strong and gone from 50 up to 68, I mean, that's a big move right there. It's unclear as to whether or not this is just going to print a lower high and then roll over again and let gravity take hold, right? So this is, I think this is very, very vulnerable right now on the XLE. However, price can do whatever it wants to do. If this wants to print a new high on here, certainly this is going to be able to bolster the rest of the market. This is XLI, this is the industrials, and you can see on the weekly chart now we've gone from a lower low, so this is a very ominous signal, lower low to now a higher high, so that is a big time reversal on here, and again, we're very, very close to the highs. Seemingly nothing is going to stop this. Now we're going to go to XLP, which is the consumer staples, and this one is about as close as you can get to the all-time highs here. Another bullish consolidation. The trend is obviously screaming to the upside. You can clearly see what a little bit of stimulus, or maybe in this case a lot of stimulus, has done for the charts, if not the consumer itself. Here's the XLU, or the utilities. This one was stuck for quite some time throughout 2015, but this descending pattern has broken out to the upside, again, very close to the all-time highs. I think you can see my point here is that each one of these is very, very close to the all-time highs, and we're seeing across the board. Across the board, we're seeing strong rallies from lower highs to lower lows, now to higher highs. So the XLB, or the building materials, is very strong off of the bottom here. XLK, two left here. XLK's got a long way to go. This is the technology, right? It still has to get back here to the all-time highs back from 2000, but still on a relative basis, relative time frame basis, still very, very strong, very close to the all-time highs. And here's XLF. Now this is going to be kind of the wild card here, because what happens with interest rates is going to mean a great deal for the financial institutions, obviously, because rising rates gives them more spread to work with. So what we have to watch for here is whether or not, and this is kind of similar to the XLE, so these two have been kind of the biggest drag across the board, but we're right at this trend line here. And if the price is able to get above and beyond this trend line, then it might be a very quick trip back up to around the 26 level again, and all-time, well, not all-time highs in this case, but relative recent highs. Okay, so that's all 9 of the sector spiders. And I guess what I'm seeing across the board is a very similar, very familiar type of move, which is this sort of upwards persistent grind into Fed action. And that Fed action is going to start to be priced into the market as of, well, maybe even tomorrow, but certainly on Monday after Janet Yellen speaks and pretty much telegraphs, at least that's the thought here, is that she's going to telegraph the June meeting policy decision, and then by proxy also the July policy decision. So she can kill 2 birds with 1 stone and put certainty back into the market. And if that occurs, then I think there's no question that the market breaks out to the upside, which again, to me, is the direction of the pain. Markets will always move in the direction of the pain. So that is your TheoTrade Nightly Report. Thanks for listening, folks, and we'll talk to you soon.